Hello, and welcome back to Cost Accounting. I'm your host, Dr. B. We are in the second week of our 8-week course here at UMGC. In today's session, we're going to be talking about cost volume profit analysis, which is the concept of what we in business call break even. There are multiple ways to identify your break even point. The word break even means when my revenue equals my expenses. Break even. That means we neither earn a profit or a loss. We come in at net zero. That's break even. There are multiple ways to identify the point of break even. We can do it through sales dollars, number of units that we need to sell, target profit, and there's a couple of other methods. And we'll talk about most of those today. So let's go ahead and get started. The first thing that we need to do when we talk about break even or anything along those lines is to understand cost behaviors. And this is very similar to what we learned about last week about cost behavior and cost terms. And this week we're going to carry with cost behavior as it relates to break even, cost volume profit analysis. Understanding how costs are related and how they interact with business, we need to identify a few different things. The first thing we need to discuss are the activities that cause costs to change. We call these activity-based drivers or activity bases. And that concept is covered a little bit deeper in the next week when we discuss activity-based costing. But it is a concept that we need to understand that drives costs to change. And the second cost behavior we need to understand is called the range of activity, which identifies changes over time as they relate to the interest of the business. We call this a relevant range. As this is a when we look at a range of cost, so from point A to point B, we know that costs change within certain ranges. It might be within a few dollars, for example, or it might be within an average that we call that a relevant range. And we'll talk more about that. So cost behavior. As we talk about variable cost, fixed cost, and mixed cost, let's take it back a little bit and identify what we talked about last week. When we look at what makes a product cost, we know that a total product cost comes from direct materials, direct labor, and factory overhead. Direct materials, direct labor, and factory overhead are the total cost of a product. We know that. So since we know that, we also understand that there are variable costs, fixed costs, and what we call mixed costs associated with the total cost of a product. Variable costs are costs that change based on the level of output. Variable costs are costs that change based off of the level of output. So, for example, the more that I manufacture, the higher my cost will be to some degree. And that's related, the variable costs are actually related to direct materials and direct labor and some factory overhead. Fixed costs are costs that do not change over time based on the level of output. That fixed costs do not change over time based on the level of output. In other words, they stay the same, relatively the same. Sometimes over 12 months, it might go up a little bit or down a little bit based off of things like increases in fixed wages or salaries, or increases in mortgage or rent costs. But for the most part, the fixed costs remain consistent over a period of 12 months. Examples of fixed costs would include things like rent, mortgage, supervisors' salaries, depreciation. Those are fixed costs. They don't change. They typically don't change over time. That's why I call them fixed. Variable costs, examples of that would be direct materials, direct labor, hourly wages, um, utilities. Those are variable costs because they typically change over time. And the third type of cost that we need to discuss as it relates to cost behavior, what we call mixed costs. Mixed costs. An example of a mixed cost is factory overhead. Factory overhead can be considered to be part of mixed costs. Example of a mixed cost would be, here's a good one. It would be rent in a shopping mall for a retailer. That is a mixed cost. Rent for a shopping retailer, mall shopping retailer. Example would be like Macy's in a shopping mall. Their rent is considered to be a mixed cost, and here's why. Here's why. They'll have a base rent. So let's say, for example, that Macy's base rent for the month is $50,000. Okay. Then the shopping mall will also charge a 3% sales rent. Okay. So what that means is whatever Macy's sells for that month, they have to pay an additional 3% of their revenue to rent. And you might be asking, oh, Dr. B, that can't be right. No, it is right. That is very true. That is how shopping malls operate. And how do I know that? Because I managed retail in shopping malls, and I used to have to pay that bill. So that's an example of a mixed cost. It's where there's a base rate plus an additional cost. That makes it mixed. It's fixed plus variable, essentially. That's what makes it mixed. Another example of that would be, in some cases, it would be utilities. The utility company oftentimes will have a base rate and then plus additional kilowatt hours, for example, we're talking about electricity. And you can actually see that yourself. If you look at your personal utility bills, sometimes you'll see that there will be a base cost plus a variable component. So it's an interesting concept, but that makes it a cost behavior. So looking at it a little bit further, variable costs change with the levels of output. And again, the variable costs typically include direct materials, direct labor, especially when we're talking about manufacturing. So here's an example. We have a company that manufactures stereo systems, and we have $10 per unit of direct materials to make one stereo system. Is direct materials, and we can see that our total direct materials cost changes with the level of output. So, for example, if it costs me $10 per unit and I make 5,000 units, my total direct materials is going to be 50,000. If I make 30,000 units, still at $10 per unit, my total direct materials cost is 300,000. That is why we consider direct materials to be a variable cost, because the total cost changes with the level of output. And this is just a nice visual representation of that, yes? Let's talk about the types of businesses, their related costs, and the activity base for variable costing. I guess it's an okay example. A university as a business, one of the cost drivers for a university are professor salaries. And the activity base for the professor's salary is the number of classes that they teach. Another example is an airline, an airline company. One of their primary cost drivers is fuel, and the activity base is the number of miles flown. Makes sense. It's kind of like your car. There's another example. Let's say type of business, a taxi service like Uber or what's the other one? Lyft. Their primary cost is fuel, and it'll be based off of the number of miles driven. Manufacturing. This one's a big one, especially since that's what we talk about in this course. Type of business, manufacturing. The primary cost driver are direct materials. That's raw materials, right? And it's based off of the number of units produced. And we could keep going on, right? And you can apply it to both retail, manufacturing, service businesses, pretty much any type of business. Any type of business is going to have a primary cost associated with that business, and it'll be based off of an activity. Makes it fun, right? Now let's talk about fixed costs. Fixed costs are costs that remain the same regardless of the level of output. Examples would be supervisor's salary, straight line depreciation. As you know, depreciation is the decrease in value of fixed assets over time. And there's a couple of other examples of fixed costs that don't change over time. Rent, mortgage, they stay the same over time, typically. Okay, here's an example. This one's based off of a supervisor's salary. This company manufactures bottles of perfume. Actually, I'm surprised that none of you selected a makeup manufacturer or cosmetics manufacturer for the project. Huh. Well, anyway. So take a look at this example. Fixed cost. And there's a couple of components I want you to understand from this example. The supervisor's annual salary is $75,000. Okay, that does not change over time, regardless of the level of output. We see on the left column, at the lowest point, the company made 50,000 bottles of perfume. At the highest point, the company made 300,000 bottles of perfume. Supervisor's salary is still 75,000. Now, what we can do with fixed costs is we can figure out the allocation of fixed costs in the production process to the respective individual bottles of perfume or individual anything, right? The individual units. So take a look at this. In the far right column, we see the column that says salary per bottle of perfume produced. At the lowest end, it's $1,500 per bottle. It would be allocated to that respective, to each bottle at 50,000 units. At 300,000 units, it becomes 25 cents. Okay. What makes that interesting is that we allocate the fixed costs to the number of units produced. Because remember, when we are running a business, we need to ensure that all of our costs are being covered with our revenue. Okay. And one method of allocating fixed costs or factory overhead, for example, which this would be considered to be factory overhead since it's supervisor's salary. We need to allocate that portion of factory overhead to the units being produced in order to cover our operating costs. We'll talk more about this as we go on. Now, looking at it graphically, we can see that it's a fixed cost. It does not change regardless of the level of output. And we can also see that the more units we produce, the allocation spread of that cost becomes lower. In other words, the more I produce, the more distributed my fixed cost becomes. Looking at it from our earlier perspective, for fixed costs, a university type business, the fixed cost would be building depreciation, and it's based off of the number of students in the building, of course. Passenger airline, the fixed cost would be the airplane itself, straight line depreciation based off of the number of miles flown. In manufacturing, very important consideration, the plant manager's salary and the activity base would be the number of units produced. We keep going on. So this helps us to better understand the cost behavior, right? Now, earlier I said that mixed costs were a combination of variable and fixed costs. These make them mixed. Mixed costs can also be called semi-variable or semi-fixed, or SEMI at the beginning of the verb, SEMI, semi. What that means is partially. So looking at the allocation, actually, this is a pretty good example. Let's look at rent. In this case, it's rental for a piece of machinery. It's another good example. So one time in my past as an accountant, I had a client that my client ran a series of office buildings. And in those office buildings, they rented the printers, okay? And this is a very common practice. And if you have a printer that you're renting, there's a fixed rate per year, and then there's an overage or what we call excess of operation. So you have to pay your base rate plus, it'd be something silly like 0.0001 cent per sheet of paper over, 20,000 sheets or whatever, something like that. But you see what I'm saying. So so this is a great example of a mixed cost. So for this example, we're renting a piece of machinery. The base rent is $15,000 per year, plus $1 for each hour in excess of 10,000 hours. So let's take a look down below at our chart. And of course, it's going to vary from year to year depending on the usage. So if I used 8,000 hours for this machine, it would just be the 15,000. Okay. If I used 12,000 hours, I would have to pay 17,000. How did we get 17,000? You might be asking. Well, we have the base rate of 15,000 plus the overage. What's the overage? Well, we want 2,000 hours over the base. The base is 10,000. So 2,000 hours at $1 for every 1,000, or I'm sorry, $1 for every 10,000. That gets us to $2,000. Does it make sense? Any questions so far? Good? Yes? Maybe? No?
Good so far.
Awesome. Thank you so much. Very good. Okay. So that's the concept of mixed cost. Mixed cost. And we can see that with mixed cost graphically, we can see that once we hit 10,000 hours, then my cost begins to rise. So that's what makes it mixed. It's fixed here up until we hit 10,000 hours. And then once we pass the 10,000 operating hours, our costs increase. That's what makes it mixed. Semi-fixed, semi-variable. And there are a couple of ways that we can separate our mixed costs. We can identify mixed costs based off of their fixed and variable components. And we can separate mixed costs based off of what we call the cost estimation method and the high-low method. High-low is exactly as it sounds. It's what we call a cost range at the low end and at the high end, right? And the cost estimation method is related to the high-low method. We'll talk about those. So let's take a look at our range, which is the high-low method, if you will. Here's some data. In this example, we have some equipment maintenance for our company. And here's what our equipment maintenance or our company has produced over the past couple of months. So we have June, July, August, September, October. Month of June, we produced 1,000 units with a total cost of $45,550. Okay, you're saying, oh, well, what's the relevance here? Let's take a look at units produced first for these 5 months. Using the low-high method, or high-low method, whatever you want to call, at the high point, our highest month was August, but we produced 2,100 units for $61,500. That's the high point. How do we know it's the high point? It's the highest number of units produced, and it's the highest total cost. Sometimes those may not always be correlated, but what we're looking for here is the highest total cost, okay? And the lowest number of units produced was in the month of October with 750 units. And we came at the lowest total cost of $41,250. That gives us the high-low method. Okay. So now that we've discovered what our high is in August, our low is in October. Using the high-low method, one of the things we do is we first need to we can find. Sorry, one of the things we could do with the high-low method is we could find the variable cost per unit. Okay. So what we do is we take the highest level first, 2,100 units at 61,500, minus our low level, our lowest level, 750 units at 41,250 to get our difference. 1,350 units at 20,250. So the first step we do to find the variable cost per unit is let's find the differences first. So difference in unit is 1,350, and the difference in total cost is 20,250. To find the variable cost per unit, we take the difference in total cost divided by the difference in the units produced. So the difference in total cost in our example is $20,250 divided by the difference in the units produced, which is $1,350, gives us a variable cost per unit of $15 per unit. So now that we found our variable cost per unit, we need to find our fixed cost, okay, using the same method. The fixed cost using the same method in the last step will be added to the variable cost to get a total cost per unit. Fixed plus variable equals mixed. Okay, so to find the fixed cost, we take the total cost minus the variable cost per unit times the units produced. Now, it's very important that you understand what we call the order of operations. Order of operations tells us that we complete what is in the brackets first. Complete what is in the bracket. There's some old sayings, right? When we were kids, they said, what was it called? PEMDAS or something? PEMDAS? I forget. There's a bunch of like little sayings to help us kind of remember the order of operations, but parentheses always comes first. So in this formula, make sure that you do what's in the parentheses first before the subtraction. Okay. So looking at using the high-low method, and this is what we do first, and this method actually helps us also to verify that it's correct. Using the high-low method, we take the total cost minus the variable cost per unit times the units produced. So our total cost in the month of August, right? Yeah, August. Month of August were $61,500 minus $15 variable cost per unit that we got from step one times the 2,100 units that we produced in the month of August. $15 times 2,100 is $31,500. We take our total cost of $61,500 minus $31,500, gets us a total fixed cost at the high level of $30,000. Now we do the same for the low level. The month of October, we had total cost of $41,250 minus the variable cost per unit, $15 that we got from step one, times 750 units. 15 times 750 equals 11,250. We take our 41,250 total cost in October minus 11,250 equals 30,000. So what does that mean? That means our total cost using the high-low method is 60,000. So we take our let's see. We take our low and our high, add them together to get the 60,000. Make sense?
Yes.
Awesome. Very good.
Yes.
Very good. This is a fun topic. One of my favorites. Okay. So that's fixed cost. Let's look at the effect of changes based off of variable and fixed costs. For variable costs, the total amount will increase and decrease proportionally with the activity level. In other words, as my output changes, my variable cost will change with it. Because as my output increases, I have additional direct materials and direct labor. with variable costs, the per unit amount will remain the same. Per unit amount will remain the same. For fixed costs, the total amount will remain the same regardless of the level of activity. In other words, the supervisor's salary that we learned earlier was $75,000. Supervisor's still going to get paid the $75,000 regardless of the level of output. However, the fixed costs will increase and decrease inversely with the level of activity. In other words, the more that is being produced, the lower the fixed cost component of that unit decreases. Makes sense, right? Okay. Variable, fixed, and mixed. Some more examples, variable, fixed, and mixed. Direct materials, direct labor, utilities, supplies. Those are all variable costs. They change with the level of output. Fixed costs are costs that remain the same regardless of the level of output. Straight line depreciation, property taxes, production supervisor salary, insurance expenses, they remain the same regardless of the level of output. And then we have mixed costs. These are variable and fixed costs combined, right? Quality control department salaries. A quality control department are the individuals that check for quality, right? What they do, and it's actually a pretty cool job. I mean, I think it's pretty cool, is they will take a completed unit and totally disassemble it and then reassemble it. What they're doing in that process is they're checking for the quality of the build. I think it's really cool. The reason why that's a mixed cost is because it's dependent on two things. One, there's salaries involved. So salary, the term is fixed, right? But they are paid additional based on the number of quality control inspections. The same with the purchasing department. Purchasing department, they will process X number of purchases, and that after a certain point, their salaries increase based on the number of purchases. I know it sounds complex. It is. Maintenance expenses. In some cases, you will for maintenance, you will have a maintenance agreement, okay, where you pay a certain amount per year for maintenance, up to a certain amount. Anything over that becomes variable. Warehouse expenses, as the quantity based off of your warehouse agreement changes, the expense increases after you've hit a certain capacity. I've seen that happen in business as well. Very interesting. So that's variable, fixed, and mixed. What is the relationship to break even? Let's talk about break even. Break even, cost, volume, profit analysis. So where we look at relationships between selling prices, sales and production volumes, costs, expenses, and profits. It's a fancy word for break even. Break even means that our revenues are covering all of our expenses. We are not making a profit. We are not operating at a loss. We have zero for our net gain, net loss. So from that perspective, we look at cost, volume, profit analysis. In cost, volume, profit analysis, this helps us in a couple of different ways. It helps the business to analyze its sales price, its changes in profits, and its impact on volume. Cost volume profit analysis also helps the business to set sales prices for their respective products. It also helps the business to identify its sales mix. Sales mix. That's a term that you hopefully have learned at some point in your business program. The sales mix is the variety of products that your business sells. And the break-even point will help you to identify what items you need to sell in order to break even, or sell more of in some cases, or less of, depends. And it also helps our businesses to select certain marketing strategies. Okay. How does it do that? You might be asking. Well, as you know, marketing involves advertising and promotion and sales, right? So the concept behind marketing is it will help us to what we call target market certain aspects of our business. Help us to sell more of a certain product. It will also give us directives on what we need to put on sale in order to sell more. It also helps us to identify how much ad spending we need in certain markets to increase sales. And we can learn a lot of how that operates through identifying break even through cost volume profit analysis. This is probably one of the most important concepts in business. Why is that, you might ask? Understanding the point of break even tells us how much we need to sell to stay in business. We don't want to operate at a loss. We didn't start this business to lose money. Okay. And every business, regardless of what kind of business it is, they need to make profit. How do we make profit? We have to be able to sell more than our expense. Yeah. I know, what a concept, right? Okay, so let's take a look at this beautiful concept called the contribution margin. Oh, I like making money. Okay, let's take a look. Contribution margin is the excess of sales over your variable costs. To find contribution margin, we take our revenue, which is our sales, minus our variable costs. The contribution margin is designed to cover your fixed costs. Any additional contribution margin contributes to what we call operating income or gross profit. Oh my goodness, there's that beautiful word, profit. Okay, so the idea behind contribution margin is it helps us to cover our fixed costs. Another way to think about it, the contribution margin is sales minus variable costs equals fixed costs. Of course, that's not the formula for fixed costs, but it helps us to understand how fixed costs are derived. So let's take a look at our income statement for our company. Our company has sold 50,000 units for the month. Okay. Our sales price per unit is $20. Our variable cost per unit is $12. Our total fixed costs are $300,000 for the month. Okay. Fantastic. Now let's make our income statement based off of this data. Very easy to do. Sales. We sold 50,000 units at $20 per unit. That means we sold $1 million. 50,000 times 20 is $1 million. Our variable costs. We sold 50,000 units at $12 per unit. Variable cost. 50,000 units, $12 per unit, variable cost equals 600,000. So we have $600,000 in total variable costs. Sales minus variable costs equals gross margin, 400,000. Another way to think about this is 50,000 units sold times $8. How $8, Dr. B? I don't, where'd you get the $8 from? Well, if our sales price is 20 and our variable cost per unit is 12, the difference is 8, right? And contribution margin is the difference between sales and variable cost. I know, amazing, right? So our contribution margin is 400,000. Our fixed costs were said to be 300,000. Remember, fixed costs are the things that we cannot change. So contribution margin minus fixed costs equals operating income. 400,000 minus 300,000 is 100,000 of operating income. That's pretty good. I think that's really good, right? So what does that tell us? We definitely did more than break even here. We did way more than break even by 100,000, right? If it were just breaking even, that operating income would be 0. Everyone understands contribution margin so far, right? Because we're going to dive even deeper.
Yes, good.
Thank you, Hannah. Appreciate it. Okay. So let's talk about contribution margin ratio. So now that you understand how contribution margin works, let's look at the contribution margin ratio. We also call this the profit volume ratio. It's a nice word, beautiful word, profit. It's what every business strives to make. So we can identify our profit based off of a percentage, or contribution margin based off of a percentage. Of course, the higher the percentage, the better. Yeah, absolutely. Okay, so how do we compute this wonderful, wonderful ratio? We take our contribution margin divided by our sales, or revenue. Contribution margin, as you know, is calculated by taking sales minus variable costs. So for example, sales, $1 million, minus variable costs, I think we said it was 600, right? Gets us to 400,000. Sales minus variable costs, 400,000. Divided by sales, 1 million. 400,000 divided by 1 million is 40%. How do you get 40%? It says 0.4 on my calculator. Get it? Times 100. Come on. Good, right? Cool. Very, very helpful. This helps us to measure the volume in sales dollars. Absolutely. As the change in sales dollars multiplied by the contribution margin equals to the change in operating income. So this contribution margin ratio will also help me to find the change in operating income. Change in operating income. Because as you know, over time, our operating income changes on a regular basis. Hopefully, as long as the business is doing well. Even if it's not doing well, it'll still change, right? Okay, so let's look at the formula. To find the change in operating income, first we find the change in sales dollars times the contribution margin ratio. In our example, let's say that our company added an additional 80,000 in sales from the sale of an additional 4,000 units. Sales price $20, additional 4,000 units, it's 80,000. Yeah. Our operating income will increase by 32,000. How did we calculate that? Well, our change in sales dollars, we said that our sales increased by 80,000 based off of selling an additional 44,000 units. So 80,000 is a change in sales dollars times our contribution margin ratio of 40%. 80,000 times 40% equals $32,000. So $32,000 is the change in our operating income. Makes sense, right? Any questions at all so far? Okay. All right. That's good. That's good. Let's analyze it. Looking a little bit further, okay? How do we confirm the contribution margin? How do we know the contribution how do we know the contribution margin is correct? So our sales increased by 80,000, right? So instead of selling 50,000 units, we sold 54,000 units at times $20 per unit. So 1,080,000. Our variable cost per unit is $12. I sold 54,000 units. Variable cost is $12 per unit. That's 648,000. Clearly that changed, right? Because we sold more units. It went up. It's variable. Sales minus variable costs equals contribution margin. We can see that the contribution margin, the per unit didn't change. Per unit did not change. But of course, the total contribution margin did because we sold more. Sales minus variable costs equals contribution margin, 432,000. Minus fixed costs. Remember, fixed costs do not change regardless of the level of output, 300,000. Equals our new operating income of 132,000. Yay. Good so far. All right. Very cool. Okay. Now, we talked about contribution margin. Now that you have a really good understanding of what the contribution margin is, let's look at it at a deeper level. Contribution margin, in a general sense, is for the company, for the whole company, the company, right? Let's look at it from a unit perspective. So we're getting a little bit more granular. We're looking at it at the individual units. Unit contribution margin is, of course, important to understand our profit potential, right? That's why we could compute unit contribution margin. Unit meaning individual units available for sale. Okay. To calculate unit contribution margin, we take our sales price per unit minus our variable cost per unit. Gets us to our unit contribution margin. Looking at our earlier example, our sales price per unit is $20. Our variable cost per unit is $12. $20 of sales price per unit minus the variable cost per unit of $12 equals a unit contribution margin of $8. So $8 is our per unit contribution margin. This is very important to understand as our sales volumes increase or decrease. Okay, sales volume is the quantity that we sell, right? Unit contribution margin helps us to identify the changes in sales volume based on taking the change in sales dollars times the unit contribution margin. We also consider this to be the change in operating income. So very, very similar to what we identified with the company as a whole, but now we're looking at it from a perspective of individual units. And it helps us to identify the change in operating income. So let's take into consideration our company sales could be increased by 15,000 units from 50,000 to 65,000 units. In other words, I can sell an additional 15,000 units. We started at 50, now we're up to 65. What is the impact on the change of operating income? So we run our calculation. Change in sales units, 15,000. I sold an additional 15,000 units. Okay. Times my unit contribution margin. Remember, unit contribution margin is your sales price minus your variable cost. Sales price minus variable cost is unit contribution margin. So $20 minus the $12 equals $8. 15,000 units in change times $8 unit contribution margin equals $120,000, which is our change in operating income. Good? All right. So let's break it down. Sales, 1.3 million. How will we get there? We sold 65,000 units at $20 per unit sales price. Minus variable cost, 780,000. Number of units sold times variable cost. Sales minus variable cost equals contribution margin of 520,000. Minus fixed costs, 300,000, equals operating income of 220,000. Yay! Yeah, that's good. That's very good. These are companies doing well. So, let's talk about the break-even point. Now that you understand contribution margin and unit contribution margin, we can now talk about break-even. All right. The break-even point is where our company's revenues equal our company's expenses. Revenue equals expenses. That is the point of our contribution, our break-even. Break-even is where revenue equals expenses. Very simple. We neither have an income or a loss. It's zero. Yeah. When you hit absolute zero, that is your point of break even. To calculate break even, we're going to do this. We'll first do this in units, and then we'll talk about it in dollars. Break even in sales units. What is this? Break even in sales units tells me the number of units I need to sell in order to break even. Break even in sales units is a number of units I need to sell in order to break even. To find out, we take our fixed costs divided by our unit contribution margin. In our earlier example, our fixed costs are 300,000 divided by our unit contribution margin of $8 per unit. So 300,000 divided by $8 per unit will give me the number of units I need to sell to break even. So broke up my handy dandy calculator, okay? So 300,000 divided by $8 per unit tells me I need to sell 37,500 units in order to break even. Break even is where revenue equals expenses. That example, what I just gave you, that 37,500, that is from this example. We're gonna do a new example to further show you the concept. So here's a new example. New example, different from the old one, yes? Okay, in this example, our fixed costs were 90,000. We have a unit selling price of $25, a variable cost of 15, and a unit contribution margin of 10. How do we find unit contribution margin? Take your sales price minus variable costs. our example, $10. Our fixed costs are 90,000. To find the break even in units, we take our fixed cost, 90,000, divided by unit contribution margin of $10 to get a break even in number of units of 9,000. I need to sell a total of 9,000 units in order to break even. Good so far?
Yes.
Wonderful. Thank you so much. I appreciate the affirmation. Okay, let's look at break even if we sell the 9,000 units. 9,000 units at $25 per unit is 225,000 in sales, minus our variable costs of 435,000. How do we get a variable cost? Variable cost $15 per unit, 9,000 units, 135. 225 minus 135 is 90,000, which is our contribution margin, minus our fixed costs of 90,000 equals zero. When your operating income equals zero, that means you've hit the point of break even. Now, we've looked at the break even in terms of units. We need to understand it in terms of sales dollars. Okay. We know how it is in units. Now we're going to look at it at sales dollars. In terms of sales dollars, this is how much revenue or sales I need to make or earn to break even. To find this, we take our fixed costs divided by the contribution margin ratio. Oh, there's that term again. Contribution margin ratio. Contribution margin ratio is calculated by taking the unit contribution margin divided by the unit sales price. Contribution margin ratio is found by taking the unit contribution margin divided by the unit sales price. Let's look at it from our most recent example. Unit contribution margin is $10. Sales price is $25. 10 divided by 25 is 40%. Unit contribution margin of 40%. By the way, it's pretty good. I think it's a pretty good ratio. Now, to find the unit of the break even in sales dollars, we take the fixed cost divided by the contribution margin ratio. Our fixed costs were $90,000 divided by our contribution margin ratio of 40%. 90,000 divided by 40% equals 225,000. For those of you trying to figure out how to divide by a percentage, be 0.4. So 90,000 divided by 40% is 225,000. I need to sell $225,000 worth of sales or revenue, right? I need to make $225,000 in revenue in order to break even. Isn't that cool? You learned how to do it in units. Now you know how to do it in sales dollars. It's so fun. So fun. Okay, what is the impact of break even on fixed costs? As you know, fixed costs do not change with the level of activity. They're fixed, right? They remain the same over time. However, some costs may change based on other factors, like advertising, changes in property taxes, changes in supervisor salaries. These things change once in a while, like we talked about earlier. So when that happens, clearly we need to change our break-even point. If our fixed costs increase, that means we need to sell more to cover our fixed costs. If our fixed costs decrease for whatever reason, that means we could sell less. If fixed costs rise, the break even must also rise. The opposite is also true. Fixed costs decrease, then our break even must also decrease. Let's look at an example. So let's say we have a company that is proposing to increase our fixed cost by 100,000. Why? Oh, they want to run a TV ad in the next month. Our current sales price is $90 per unit. Our current variable cost per unit is $70, giving us a unit contribution margin of 20. Our current fixed costs are 600,000. If we run our TV ad, our fixed costs will increase to 700,000, with all else remaining the same. So if I don't increase my sales price, how many more units do I need to sell to break even? As you know, break even is fixed cost divided by unit contribution margin. So currently, my break even is 30,000 units. Fixed cost 600,000 divided by the $20 per unit contribution margin. That's 30,000 units is my current break even. If I decide to go with our TV ad next month, my fixed cost will increase to 700,000 divided by the unit contribution margin, which is still $20. My new break even point is 35,000 units. That means I'll need to sell an additional 5,000 units to break even. Cool, right? I think so. I think it's cool. Now that's the impact on fixed costs. What about variable costs? Variable costs, as you know, may be impacted by changes in the cost of direct materials, changes in hourly labor, or changes in things like sales commissions, I guess. Yeah, sure, why not? So the variable costs only change if there's a change to direct materials or direct labor, pretty much. So when there is a change to the amount of the direct materials cost or the direct labor cost, then we must change our point of break even. If there's an increase in variable cost, we increase the break even point, and the opposite is also true. So if there's an increase to our direct materials cost or an increase to our direct labor cost, for example, the cost of aluminum went up. There's a union dispute and the hourly wages went up. In those cases, then we must also increase the point of break even. The opposite is also true. So let's take a look at an example. Let's assume that our company is proposing to pay our salespeople a little bit more. Well, that's cute. That's nice. Extra 2%. Oh, how nice. Okay. Our current model, our sales price is $250 per unit. Our variable cost is $145, giving us a unit contribution margin of $105 per unit. Our fixed costs are $840,000. Now, if I increase my commission by 2%, that means my variable cost will increase. My sales price remains the same at $250. My variable cost per unit increases to $150 per unit. That means my unit contribution margin decreases by $5 to $100 per unit. My fixed costs are still the same. So how do we get $150, you might be asking? 2% times the sales price, because it's commission, right? Which commission means what we pay our salespeople based off of the sales price. Yeah. So if I pay them 2% increase, that means I multiply my sales price times 2%. That gets me to plus the original $145, which represents the increase. So 2% increase from 145 is 150. So we can see that my unit contribution margin went down. What does that mean when that happens? It means I got to sell more, right? So before the 2% increase, fixed cost 840 divided by unit contribution margin of 105 equals 8,000 units is what I need to sell. If I decide to increase my commission to my salespeople by 2%, my fixed cost is still 840 divided by the unit contribution margin. Now my unit contribution margin is 100. That means I need to sell 8,400 units in order to break even. Fun, right? It's interesting. It's interesting. So we learned about changes from fixed cost and from variable cost. Now let's take a look at it from the perspective of a change of the selling price. Oh, sometimes our sales price of our products change. Actually, most of the time they do, right? Sometimes we might decide to put a product on sale, or we might decide to increase the price because of high demand and low low inventory. Things happen, right? So as I change my sales price, there will be a respective change on the break even. Now, here's where it gets important. This is an inverse relationship. In other words, it's opposite. If my sales price increases, I can decrease my break even point. If my sales price decreases, I must increase my break even point. Inverse relationship. Sales price goes up, then my break even comes down. That makes sense. I can sell less and break even if my price is higher. If my sales price goes down, that means I need to sell more to break even. Let's look at it from an example. Different example, totally different company. Okay. Now, I currently sell my products at $50 per unit. My variable cost is 30. My unit contribution margin is 20. Sales minus variable cost equals contribution margin. I want to raise my prices by $10 to get a little bit more, a profito, per unit. Yeah, got to make it a little bit more money for whatever reason, right? So, proposed sales price of $60 per unit. That's an increase of $10 in the sales price. Variable cost remains the same, $30 per unit. And my contribution margin has increased by $10. Why? Because sales price minus variable cost equals contribution margin. Let's take a look. So fixed cost, 600,000 divided by unit contribution margin of $20 equals a current break even of 30,000 units. Right now I need to sell 30,000 units to break even. If I raise my price by $10, my sales price by $10, that means my unit contribution margin has also increased by $10 because my variable costs remain the same. So if I want to raise my price, I take my fixed cost, 600,000, divided by my new unit contribution margin of $30 equals 20,000 units I need to sell in order to break even. Ooh, that kind of looks interesting. That looks attractive to me. It means I could sell less and still be okay. So let's recap on these types of changes and their effect on break even. As fixed costs rise, my break even must rise. As fixed cost decreases, I can decrease my break even. For variable costs rise, my break even must rise. Variable costs decrease, my break even decrease. The only different one here is our sales price. If I increase my sales price, my break even decreases. If I lower my sales price, my break even increases. Pretty cool. Now, we learned a lot about break even. Now you have a really great idea of how break even works in terms of units and in sales dollars. You got that down. I know you got that down. Now, let's look at the concept of cost volume profit from a profit perspective. The idea of business is that we earn a profit. That's why we go into business in the first place, right? Hopefully. Okay. There's a concept called target profit. What target profit is this is the desired amount of profit. This is how much I want to profit. Okay. This isn't how much I want to sell. This is how much I want to profit. This is how much walking money I want. After I this is my desired operating income, right? So my walking change. Okay, how do we calculate it? We take our fixed costs plus our target profit divided by unit contribution margin. Target profit, again, this is how much I want to earn in profit and earn an operating income, yeah? Okay, so here's a lovely example. Our new company, we have fixed costs, 200,000. I want a profit of 100,000. It's a nice profit. I want to make 100,000 at the end of the year. Beautiful, sweet, wonderful. Sounds great. So fixed cost, 200,000. Target profit, $100,000. We have a unit sales price of $75 per unit, variable cost of $45 per unit, giving us a contribution margin of $30 per unit. Remember, unit sales price minus unit variable cost equals unit contribution margin. So $30 per unit is our contribution margin. So let's find out how many units I need to sell in order to generate a $100,000 profit. We take our fixed costs, 200,000, plus our target profit, 100,000. By the way, that's 300,000 divided by unit contribution margin of $30 per unit equals 10,000 units that I need to sell in order to generate a profit of 100,000. Make sense? Yes?
Yes.
All right. Thank you, Hannah. Appreciate it. Here's how it looks on the income statement. Sales, 750,000. $75 per unit, 10,000 units. Okay, that's how many I need to sell to make $100,000. Minus variable cost, 450. Variable cost, $45 per unit, 10,000 units. Contribution margin, 300,000. 7 sales minus variable cost equals contribution margin. $30 per unit is my contribution margin, 10,000 units. Minus my fixed cost, 200,000, equals operating income. Yeah, 100,000 target profit. That's what I'm talking about. It's the idea behind it, right? Got to make profit. Okay, we just learned how many units we need to sell to generate $100,000 in profit. Now, let's look at it from another perspective. How much revenue do I need to make in order to generate a $100,000 target profit? All we're saying here is how much sales I need to make in order to make 100,000 profit. Not units, but sales dollars. So On my income statement, it said that I generated $750,000 in sales to make 100,000. Here's how it works. Okay, this tells me how much I need to sell to make 100,000. We know it's 750,000. How did we get that number? So the first thing we do is we figure out our contribution margin ratio. Unit contribution margin, and we said it was $30. That was our sales price minus our variable cost equals unit contribution margin, $30. Divided by our sales price, $75, gives me a unit contribution margin ratio of 40%. Okay, so we got that down. Now let's calculate it out. To find the amount that we need to sell, sales dollars, how much revenue we need to make in order to generate $100,000 profit. We take our fixed costs plus our target profit divided by our contribution margin ratio. In our example, fixed cost 200,000, target profit 100,000, that's 300. Divided by 40% equals $750,000. Yay! Cool, right? Oh, I know you guys love this stuff almost as much as I do. Okay. The cost volume profit analysis tells us, the company, how much sales we need to generate, at what our costs are to generate a profit or a loss. Or hopefully we break even, right? At minimum. We can chart this out if we really wanted to. This is just nice to know information. We're going to breeze through these next few slides. We can chart it out on a visual, how much I need to sell. So we have the horizontal and vertical and lines, right? Step one on our horizontal, we look at the range in terms of sales dollars. Okay. And on our vertical, we look at it in terms of cost. Okay. Step two, we plot the line connecting point 0 to the left and to the right. Step three, we chart the line. We chart the line. Step four, we identify the point of break even where our sales and our total cost lines cross. Who would have guessed? Here's a new example, looking at it graphically. Fixed cost 100,000, sales price $50, variable cost 30, contribution margin is 20. Remember, sales price minus variable cost equals contribution margin. Here's how it looks graphically. So we can see step one, number of units, yeah. Step two, we have our vertical, our vertical in terms of sales and costs, right? And then step two, we have the line. Step three, we have the line. Step four, we identify the point of break even. Okay, so that's just a nice way to show where the break even point is from a graphical perspective. I'm not going to ask you to do that in this class, but it's good to know because you might see something like this later on. Hint, hint. You might see it on your homework. You might see it on an exam, possibly. But it's just looking at it graphically. I'm not going to ask you to create the graph. You don't have to do that. If you want to, you can. But I'm not going to ask you to do that. I might ask you, where's the point of break even based off of this graph? Well, we can see sales and cost 250,000, 5,000 units is my break even point. Oh, if I want to generate profit of whatever, you get the point. But it's it's nice to know. It's nice to know from a graphical perspective of what is the point of break even. And you can look at it from this perspective, point of break even, operating, profit is of course above break even, below break even is a loss. We know that. So as managers, uh, we need to understand what is our sales mix. Earlier, we talked about the sales mix. These are the types of products that I sell. Some companies don't always sell the same product. They usually have a couple of different products in their portfolio. We call this a sales mix. These are the different types of products sold by the company. We would perform the same type of analysis on each product that the company sells. So in this example, we have product A and product B. We do the same exact thing, right? Sales price minus the variable cost equals the unit contribution margin. We have uh, additional data. We have the units sold, and then we have the sales mix. How do we find sales mix, you might be asking? And I'm sorry, I don't know what happened in that slide. This, for some reason, this guy must have moved when I was building this earlier. So looking at this a little bit closer, to find the sales mix, we take the number of units sold. Where am I? I'm sorry. Okay, so the I'm sorry, this is additional data. My apologies. And I don't know why I did that. Sometimes these slides get a little crazy on me. Okay, there we go. Oh my goodness gracious! I apologize about that. Okay, so here's some data. Okay. We sold a total of 10,000 units across two different products. To find the sales mix, we take the number of units sold for that respective product. For example, product A, we sold 8,000 units, divided by the total units sold for the company. In this example, it's 10,000. How 10,000? Product A is 8,000, product B is 2,000. That's 10,000 together. So 8,000 units divided by 10,000 units equals 80%. So this tells me that I sold 80% of product A and 20% of product B. That's my sales mix. And here's how it looks graphically. Sold 80% product A, 20% product B. This information is helpful for the company to identify its sales mix, expresses a percentage, and it also helps the company to identify its contribution margins for each product within the sales mix. Oh, I did it again. I'm so sorry. For some reason, it must be the software I use to build some of these slides. So looking at it from this perspective, we have product A, product B, and the overall enterprise, we just label it as product E. That's like the whole company together, right? Product A sales price, we get an average sales price. So product A plus product B equals product E, which is the average. How do we find the average? We take the sales price times the respective sales mix ratio. $90 times 80% plus $140 times 20% equals $100. That's the average, company average. We do the same thing for variable cost and the same thing for contribution margin. What this information helps us to do is it helps us to identify the number of break even in sales and dollars and in unit dollars, how much we need to to sell to break even for the whole company, not just by individual products. So this is how we would do it for the whole company. Okay. Fixed cost divided by the unit contribution margin for the whole company equals the number of units I need to sell to break even. Make sense?
Yes, it does.
Great. Thanks, Maxwell. Appreciate it. And when we have multiple products, of course, we have these listed out on our income statement. This is an example of it. Sales minus variable costs equals contribution margin minus fixed costs equal operating income. So as we can see, our operating income is zero in this example. Zero is what we want to break even. It's really, oh my goodness, look at me. I'm all over the place today with these slides. I swear I fixed this before, but sometimes it just shows up a little funny. One of the last concepts we'll cover today is called operating leverage. Leverage is really important to understand because leverage tells us how well we are utilizing our contribution margin and our operating income. Operating leverage is a relatively simple formula. We take our contribution margin divided by our operating income to get operating leverage. Operating leverage, we take our contribution margin minus our operating income equals our fixed costs. Companies with high fixed costs have high operating leverage. So let's take a look at some sales data. Our company, and we're comparing two different companies to identify which company has the best operating leverage. Sales minus variable cost equals contribution margin minus fixed cost equals operating income. So we take the contribution margin for each company divided by the operating income for each company equals the operating leverage for each company. So for Jones Company, we have a contribution margin of 100,000 divided by the operating income of 20,000 equals 5. So 5 is a pretty high leverage. And of course, the higher, the better. That's what this example shows you. And we, of course, we could express the operating income as a percentage, percent change in operating income. What this tells us is it helps us to measure the impact of change in sales dollars on operating income. To find that, we take the percent change in sales times operating leverage. To find the percent change in sales, what we do is we take our, where am I? Percent change in sales, we have a change of, in this example, a change of 10%. To find that, we recognize the $400,000 in sales at 10% increase is 400,000, 10%. So change in sales price 10%, or change in sales, sorry, 10% times the operating leverage of 5% equals 50% percent change in operating income. We do the same thing for the other company as well. And again, this information is just, really helpful to know, right? And it's a nice way to validate it. Oh, I did it again. My goodness, I'm so sorry about that. I don't know what's going on with me. This is a nice way to validate that information. We are almost done. Last topic, margin of safety. Margin of safety, it sounds, the word is exactly as it sounds. This gives us a margin of safety. If it's like a safety buffer, right? This indicates a possible decrease in sales that might occur. Okay, it's kind of like a warning that goes off. right? Like, oh, our sales are going down. Okay, well, that's a problem because, that's going to impact our contribution margin, right? So, margin of safety, we can express it in dollars, units, percentage of current sales. We take our sales minus our sales at our break-even point divided by sales, and that gives us a margin of safety. So here's an example. Sorry, I did that again. My goodness, I don't know what's going on with me today. Okay, margin. So we have in our example, sales 250,000. The sales at the point of break even is 200,000, and the unit selling price is $25 per unit. So in sales dollars, it's 50,000. We take our sales minus our sales at break even point. That gives us our margin of safety in terms of dollars. In terms of units, we take our sales minus our sales dollars at the point of break even divided by our sales price. So 50,000 divided by 25 gives us 2,000 units I need to sell for the margin of safety. We can express this as a percentage. We take our sales minus sales break even point divided by total sales. It's 20%. 50,000 divided by 250. And therefore, we need to maintain 20% or $50,000 or 2,000 units before a potential operating loss occurs. That's what I call it margin of safety. We're not going to go too deep into margin of safety in this course, but I just really wanted you to all understand that concept. And that actually brings us to the end of today's presentation and cost, volume, profit analysis. Hopefully this will be helpful for you in more than one way, right? Number one, hopefully it'll help with the homework assignment. Number two, hopefully it'll help you with your 10K projects. And number three, it will hopefully also help you with your first exam that's coming up. I think it's next week, maybe, if I'm not mistaken. Yeah, week 3. Yeah. Yeah, that's right. It'll be on week 3 exam. I think, right?
Are the exams in Gleim as well?
They are, yes. Yep, everything is in Gleim. For homework assignments and exams are all in Gleim. If you need help accessing it, if you haven't accessed it already, reach out to me, send me an email, and I will connect you with the Gleim representative to get you set up.
And for the quizzes, are they going to be just one attempt rather than the 2 that we get with homework?
That's correct. Yep. So, and that's why most of our courses are set up. So, looking in Gleim, sorry, I just want to, I don't know why I did that. It usually remembers. Okay. Sorry. Looking in Gleim, the homework assignments, what you just called a quiz, but homework assignment, those you get 2 attempts on the homework assignments, and there'll be 1 attempt on the exams. That's correct. And your first exam is coming up. It will become available this coming Wednesday, so a week from today, and it'll be available through April 6th. Excellent question. Are there any other comments, questions, concerns that I could help to answer at this time, whether it be for the content we just talked about or for anything in the class?
Professor,
Santa.
so the homeworks are quizzes, correct?
Yeah, you could call it that. It's a homework assignment is the same as a quiz. It's the same idea. That's correct. Great question. Any other questions, comments, concerns? Okay. Well, first off, I want to thank you all again so much for your time today. I'm sorry that we went a little bit over time. I thought that this was a good session. It was important that we covered all this information. For this week, just to kind of recap, You have your 10K discussion. This one is on the financial statements. You'll go through and you'll answer the 3 questions and prepare a trend analysis. This information will also be very helpful for you as you work through the project, because when you go to submit your draft in week 6 and then your final draft in week 7, this will help you to put it all together. That's why each week we do a little bit through the discussions. It helps. It's helpful in 2 ways. One, it helps me to identify that you're on track. And the second way it's helpful is that you'll be able to utilize that information when you're writing your final report and you're putting together your PowerPoint presentations. And then the other thing you'll have to do this week is homework assignment 2, which is in GLIME. It's that homework 2 or quiz 2, whatever you want to call it. Any other questions, comments, concerns? We're good? Okay, so thank you all so much for your time today. I really appreciate it. If you think of anything, I'm here for you. Just send me a quick email. You could talk to me through the discussion forums. You could call me. I'm available for you 100% of the time. So thank you all so very much. I appreciate all of you, and I hope you all enjoy the rest of your day, evening, night, wherever you may be in the world, or morning. And stay safe. Wash your hands. Do the right things. Thank you all so much. Take care.
Thank you so much.
Thank
Bye,
you.
Professor.
All right. Bye-bye. Take care. Bye-bye.